Why do you want to sit in cash in this market with this backdrop?
Well, I think there are a number of things going on. First, let me say, I think the Fed has played this month perfectly. And given all the chaos, that may seem to be a conundrum to a lot of people, but think about it. They got last year wrong. Inflation got away from them. They walked in this year. They admitted they got it wrong, went out there, all the FOMC members talked about all their tools were in play, then went into their quiet period and let us in the market hash it out. So they come into today's meeting knowing what the meeting expectations are. March liftoff, 4 rate hikes, QE ends in March, and some conversation about QT at the end of the year. They didn't have that information 2 weeks ago, so they are now playing it, I think, very smartly. My concern is those things won't be enough. The inflation genie is out of the bottle. They're going to try to thread the needle and go with the market consensus. I think we heard that from Waller. They don't want to surprise the markets. They got enough for this meeting. But we think down the road, they're going to have to accelerate a number of things, including rate hikes. We think they're going to have to go to every meeting, 25 basis points. And QT, we hope that's a Jackson Hole conversation. That may be pulled forward.
But
and then
Michael,
you have to watch the caps.
Let's get into it. Before we get to the caps on balance sheet reduction, it's really, really important, really nuanced. We need to spend some time on that. You're looking at potentially a hike at every single meeting, balance sheet reduction that could come earlier, maybe totaling 1.5 trillion through the end of 23. And you think that's what it's going to take to get inflation down. Bob, what does the market look like if they deliver everything you just said?
John, you have to understand, central banks broke a 30-year promise to us. They told us the one mistake they would never make is to let inflation get away from them. And it has, in every part of the world, in every economy. And now you listen to the Fed at the start of this month, they're back on their heels. And they've got a fight ahead of them because inflation is getting entrenched. It's in the price of shelter. It's in employment. They've got a couple tough months ahead to look at inflation data. So we think that the inflation battle is much bigger than either they're estimating or admitting. So yes, they should bring forward those hikes. John, if they do 4 rate hikes this year, a year from now, we're looking at a 1% Fed funds rate. Deflate that by the inflation that's going on today.
Bob,
that's minus 6 to 8%.
A lot of people actually buy into the transitory idea, or at least that this will be a passing surge in inflation. That's actually the market expectation. If you look at Fed funds futures, if you look at some of those forward indicators in terms of break-even rates, what's the market getting wrong? What data points should traders be looking at to confirm the view that you put out there?
They've been brainwashed by the last 20 years that inflation never goes higher than 2.5%. So I agree. It's all transitory. Things will slow down. Inflation will come down. But where will the economy slow down to? Still above trend. You've already closed the output gap, so you've got that inflationary pressure working as well. Will inflation slow down to 2.5%? I don't think so. I think over 3%. And by the way, the oil shocks in the 70s, those proved to be transitory too, but it took an awful lot of central bank ammunition to contain them.
Can they stay on a measured dialogue, a measured cadence, a measured set of speeches? Or do they say, as you just stated, Bob, we're going to move up 4 rate hikes, but along the way, we're going to monitor and adjust and change if we have to? Why can't they say that?
Well, I think they will, but I think today's meeting would be a lost opportunity if they just did that, because the next couple months of inflation data are going to put them back on their heels again before it starts to slow down. So I'll give you that. So why not do something? Why not at least come in today and say, you know what, we've put out the schedule of large-scale asset purchases to Feb 15. That's the last one. And in that, a month early, that's kind of halfway priced into the market. Go with the 4 rate hikes, but leave the optionality there to go to every meeting. I've heard a lot of discussion about 50 basis points at a conversation with a client yesterday. And I think 50 basis points is pretty destructive. That reminds me of the end of the tightening regime in 1994, 1995.
Yeah.
Bob, can we just finish on the technical stuff, because you did mention it and I promised you some time on it. The balance sheet reduction that a lot of people expect now is about 1.5 trillion from the middle of this year to the back end of 23. As you know, on the balance sheet at the moment, there's a ton of T-bills. Bob, you mentioned the word caps. How do you think they manage the roll-off?
Well, when they were doing quantitative tightening previously, they had caps at 50 billion per month. We think that's a good starting point, but ultimately they should go to 100 billion in caps because the balance sheet is a lot bigger, and they actually don't belong in meddling in the markets to the extent that they have. They don't belong owning as much of the mortgage market and the treasury market as they have. That should be left to free market participants like myself to price, not to the Fed, not in a recovery.
Bob Michael, conviction trade right now, what is it?
So my conviction, there's been a lot of repricing in the market, but I'm still a seller of rallies. Can I also just ask, I heard that Bill Dudley's going to be on later.
Yeah.
I think the question you have to ask him is he brought financial conditions indices to the Fed, which is really a private markets concept. Of course, us in the markets love them. But is that really something that belongs at the Fed? Is that how they missed inflation? Because they were too concerned about people like me throwing our toys out of the baby carriage? And a question for Tom. Tom, I know you were around when Volcker raised rates from 5% to 20%. Can you imagine, I was there also, can you imagine if he looked at financial conditions indicators, what do you think he would have said and done?